the Furnished Holiday Let regime is being abolished. And so imagine receiving a total income of £60,000 per tax year from lettings with a mortgage interest of £10,000 per tax year. How much tax are you going to pay? Under the Furnished Holiday Let, you will pay a tax of £7,486. Under any other residential lettings, you will pay a tax of £9,432. So the difference is £1,986. This will be the situation from 6th of April 2025 if you don't do anything before this date. If this is your first time here, my name is Amma, a qualified accountant and a tax professional from AB & Co Accounting and Tax Services Limited. On this channel, I cover topics around legal ways of reducing your tax, accounting and finance in general. And so, if you want to keep more of your hard-earned money in your pocket, hit on the subscribe button. In this video, I will not be providing any advice. For personal, tailored advice, please contact us or speak to your advisor. So now let's quickly move on to the benefits that you have if you currently own Furnished Holiday Let property. The first benefit is around the mortgage interest. So currently, for Furnished Holiday Let, the mortgage interest is an allowable expense, and so it reduces the rental income before tax. For any other residential property, the mortgage interest is not an allowable expense, but rather you get 20% relief on the mortgage interest. Another benefit that you get from owning a Furnished Holiday Let is that Furnished Holiday Let is classed as a business. And so when you sell it, you benefit from some reliefs such as business asset disposal relief, gift relief, and rollover relief. In addition to this, if you own a Furnished Holiday Let and you sell it, as long as it meets the business asset disposal relief criteria, the net gain will be taxed at 10% for any net gain falling within the first £1 million. This is not the case for any other residential property. If you sell any other residential property that is not a Furnished Holiday Let, the net gain will be taxed at either 18% or 24%, depending on your other income. Another benefit that you get from owning a Furnished Holiday Let is surrounding the income that you receive from the Furnished Holiday Let. Any income you receive is classed as earned income and so counts towards your relevant earnings for pension. So this is very important for landlords, as the amount of pension contributions that you obtain tax relief on depends on your earnings. The last benefit that holding a Furnished Holiday Let offers is around capital allowances. If you purchase any initial furnishings for the property, you are able to claim capital allowances on the initial cost of those furnishings. Currently, if you own any other property that is not a Furnished Holiday Let, you will not be able to claim capital allowances on the initial cost of furnishings for the property. And so these are the benefits that you get if you own a Furnished Holiday Let. These benefits are going to change from 6th of April 2025. And so what do you need to do now that you wait for that date? Before then, if any part of this video has been useful, please send us a signal by hitting on the like button. Right, so from 6th of April 2025, these are some of the changes that are coming in place of the benefits that I previously provided. So the mortgage interest that is currently an allowable expense will no more be the case. You only obtain 20% relief on your mortgage interest. Income received from the property will no more be classed as earned income, and so will no more count towards your relevant earnings for pensions. When you sell the property, the reliefs that were available for Furnished Holiday Let will no more be available it will be taxed in line with any other residential property. So you will no more get any relief. You will no more be able to claim capital allowances on any initial furnishings that you need to make. And so these are some of the changes that are going to be in place from 6th of April 2025. What are some of the things you need to put in place to ensure that you benefit from a reduced amount of tax even after the change from 6th of April 2025? The first thing you need to do is to check if you hold any property in your sole name. If you do, you may consider transferring a proportion of this property to your spouse to benefit from a reduced amount of tax. Transferring a proportion of the property to your spouse will help you share the income from the property, especially if your spouse is a basic rate taxpayer. They will be able to enjoy reduced amount of tax within the basic rate tax band. The next thing that you may consider is selling the property to benefit from a tax rate of 10% if the property meets business asset disposal relief. If you wait until 6th of April 2025 and then sell it, you will not benefit from a tax rate of 10%. Another thing that you may consider is check if it's legally right to increase your rent to compensate for the increased amount of tax that you may incur from 6th of April 2025. Again, if you're now paying a higher amount of mortgage interest, consider looking around for a lower mortgage interest rate to lower your mortgage interest amount. Another thing you may consider before 6th of April 2025, if you need to buy any new furnishings, this is the time to do it to benefit from claiming capital allowances. If you have any capital allowances pool, you will be able to carry this forward even after the change to benefit from claiming written down allowances going forward. So this is the time to consider that. Claiming capital allowances reduce the amount of tax that you pay. So these are some of the things that you can implement going forward to ensure you pay less amount of tax and keep more of your hard-earned money in your pocket. If you found any part of this video useful, please hit on the subscribe button. Thank you for watching.